Yes, Sophia said she's been a little late, so we can start without her.
Thank you very much. Hi everyone, it's a pleasure to see you again. And today we have lecture 3, option pricing for one period model. At the previous lecture, we had a short excursion into finance, and we discussed about possibility which 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 has investor if the financial market exists and he has access to this market. And it was deposit, it was trading by stocks and using derivative. And we discussed some terms, definition and structure on financial markets, which are essential from our course. The aim of our lecture to construct the model of financial market. Many scientists in different times wanted to build a model of financial market, wanted to predict the next value of stocks. The Kendall wrote, for example, that it's like the demon of chance. Draw a random number and add it to the current price to determine the next price. Mandelbrot compared a stock exchange with a black box or a live organism that input information and output behave according to rules to be deduced. What are the rules? How we can learn and deduce this rule? We remember that the stock prices are very fluctuated, and at any given moment they are exactly balanced between demand and supply. If we would like to model anything and financial market too, we should to make some assumption. And now about history and about assumption. Maybe you will be surprised how much scientists have Nobel Prize for modeling financial market. You see, Bachelier in 1900 perhaps was first who modeled Brownian motion, modeled stock price on the Paris Bourse, predated Einstein by 5 years. Bachelier proposed a random walk, and Einstein only through 5 years proposed Brownian motion, and Brownian motion is a limited process for random walk. Samuelson in 1965 rediscovered the work of Bachelier and proposed geometrical Brownian motion. He considered not only stock prices but difference between stock prices. Nobel Prize in 1917, and Markowitz and Sharpe developed portfolio theory. Um, and they are Nobel laureates too, but I should write what is year. Very famous works, Merton and Scholz. They published their formula for fair option pricing, and they got Nobel Prize in 1997. And Engel get Nobel Prize in 2003 for Arch model. It is the model for financial market too. Eugene Fama proposed efficient market hypothesis. He proposed this hypothesis in 1965 else, but Nobel Prize he get only in 2013. And Mandelbrot proposed fractal geometrical Brownian motion, and we get not Nobel but Wald Prize in 1993, and he proposed idea of financial market hypothesis, but Peters formalized this hypothesis in 1991. So you can see that there are two main hypotheses. It is a hypothesis of efficient market and fractal market. About efficient market hypothesis. This hypothesis states that asset prices fully reflect all available information. And about the type of information, about the type of available information, you can read in Fama papers. And this hypothesis required that agents have a rational expectation. What does it mean? That means that if the stock price, for example, goes up, so all agents buy their stocks, or opposite sell. But if it's rational, but then don't differ. The next, investor reaction be random and follow a normal distribution. So the net effect on market price cannot be reliably exploited to make an abnormal profit. And we use this as the mathematical expectation of profit is zero. A direct implication is that it's impossible to beat the market. So there doesn't exist arbitrage as a trading strategy. What is a strategy of absent arbitrage? It is a trading strategy to give a profit without risk and without initial capital. But direct implication of efficient market hypothesis that doesn't exist arbitrage as a trading strategy that has some probability of making profits without any risk of loss. So we can do risk neutral probability assignments. And at this slide, you can see a brief overview of option pricing. Uh, it is the one period binomial model on this lecture and on the next lecture. After that, the multi-period binomial model, replicating strategy, pricing European and American option in the binomial lattice, and the Black-Scholes formula. Um, Maybe you know that there are another approaches to modeling market, to option pricing, to trading. It is a technical analysis, fundamental analysis. But in this course, we should statistical approach and quant approach. So you can see on this slide the model for stock price dynamic. It is binomial model. We have one, two, three period, and we should that will be given the initial price and the coefficient U and D, how we can change the next value of stock price. Today it's 100, but on the next period this price can go up to 107. So the coefficient U, it's 107 divided by 100. So it's 1.07, you see, yes? And the next value, this 114.49, we can get using this rule. 107, we multiplied by 1.07, and we obtained this value. And so on, if the price goes up. But if the price goes down, there are another coefficient. It is coefficient 0.936, and if we multiply 100 for this coefficient, we get this value, and after that we can multiply this value by 0.936 and get this value, and so on. But if we would like to get this value, we we multiply by coefficient D. It is 0.936, but after that multiplied by coefficient U. This coefficient 0.107. So, so we can have information about initial value of stock, coefficient U, coefficient D, probability for this two scenario, and we should to know what will be with $1 invested in the cash account. So in the other groups, we should to know interest rate. Today we are going to speak only about one period binomial model. For one period binomial model, what are given? Given interest rate, given the probability space, and this probability space should have only two scenarios, only two outcomes, omega 1 and omega 2. Not n scenario, because if we have n scenario, we have not binomial model but n-normal model. Binomial means that only two scenarios, and mm, we should given that be given bank asset as function b from d. That means that we should to define this bank as this value at 0 and at the end of period. But in this for binomial model, we can only to give interest rate.
I'm sorry, I don't understand. Bank asset. What is bank asset?
A bank asset, it is as interest rate, but sometimes I wrote it in general because for the continuous case, bank asset can change it every time.
And
But
what is T?
if we have binomial model, the bank asset at only interest rate.
So it is equal to interest rate.
Yes, it's equal. In our yes.
And what is T inside the bracket?
What is this
Letter T.
letter T?
Yes.
It's time.
Time. Okay.
It's time. So in continuous case, every time the interest rate can be changed. And this is a process, price process for underlying asset. Mm, In our case, it means that we should to define initial value and value at the end of period. So if we know this, we count that we know this price process, and we should define strike process of the option. Pio function and fair price of derivative, um, it is our aim to define this. And for example, in this slide, we can ask how much is call option that pays maximum from S1 minus 120 at t equals 1. So from this, no, this means that the strike price 102. And the next very interesting questions about various of probability p, because if we have probability space, so we have the probability. We should have probability for every scenario, and at this picture you see that probability that the price goes up is p and to go down is 1 minus p. It may be our expectations, for example. And now for explaining the another example. In this example, why another example? Because in this example, for your function is 7 2. This for your function differs from option for your function. For call option and for put option, you see. because at these slides, if we would like to write for your function for call option, what it will be for your function. For this example, if strike price of the call option 102, so for your function will be send me please. I'm waiting. It's material of the lecture 1, yes? If we have call option and strike of call option is 102, what is for your function for this call option?
It's going to be 107 if the price goes up, and 102 maybe if the price goes down. I'm not considering the price of option here.
No. What do you know about call option in general? No, for example, about call option.
There's an agreement that give you a right to buy, or we're talking about the call option, to buy an asset before the expiration date of that call option.
Yes, you're right. So what we win if we have this call option?
Well, it's going to be S minus strike price minus B if price goes up. And
yes, you say about net profit.
Yeah. Yes.
But if I would like only for your function, so it is value without the cost of option, the premium.
Oh, so it's just S minus K.
In this case, what's for your function for call option?
Price minus strike price.
And it will be
5.
5. Yes.
Yeah, 5.
I'm sorry. So for your function, this is a number. It's not actually a function.
Yes. For your function, it is how much this call option pays for me at the end of the period. What is for your function? What my win? At this scenario and in this, in up scenario and in down scenario. So in the up scenario, we have say me again. $5. Yes.
Yes.
Because strike price 102, so the difference $5. But at the down scenario,
0.
Yes, because we shouldn't use. We can't. We haven't obligation, so we threw it and so on. But in this example, I would like to show that there are another derivatives which have some numbers as at up scenario as at down scenario. Not 0, but for example 2. What is this derivative? It doesn't matter for us, but it's given. And given the stock process, it is the value at the beginning of period and the two values of the end period. because this value it is up scenario and this value it is down scenario. So two values, and interest rate 1/9. And what is probability approach?
I'm sorry, I didn't get the previous. Yes, this example. We have the probability 1/9 and what?
This it's not probability, it's interest rate.
We have interest rate 1/9 and what? I don't understand. Why do we need it? I don't understand.
Yes, Thank you, thank you. And we need to find a fair price of these derivatives.
Fair price.
How much should it cost?
Fair price is the premium.
Yes, yes.
Okay.
Fair price of premium of this, because premium it is it is a market price. Of course, this derivative, but we would like to define the fair price.
And how should we do it?
And how should we do it? We would like maybe you can propositions how we can find it. No.
I don't have as a make a question.
If we use probabilities approach, maybe the fair price of this derivative will be a mathematical expectation. Yes. How do you think? It's nature, it's logic. Yes, mathematical expectation of this value. For example, 7 multiplied by probability plus 2 multiplied by probability. But this doesn't work. And this approach consists in follow that we should before to find out what are probability which which prevent that the discounted profit is 0. So we would like to realize this assumption of efficient market hypothesis. And according to this assumption, we should to find probabilities and using these probabilities, the profit is 0.
The discounted profit should be 0.
The discounted profit is 0.
And how I don't understand. We have this example, and should we do something with this example or not?
Yes, maybe this now I'm going to explain using example, and after this will be the general rule. So in this example, it is two scenario. The first scenario, the price is go up to 20 divided by 3, and in this scenario 40 divided by 9. And the profit delta S, it will be only profit. It is this value minus 5, because 5 it is value of initial cost. And in this, is it clear?
Yes.
Yes, but this is with star. It is discounted profit. And for discounted profit, we should this value at the moment, at the end of period divided by discounted factor. So divided by 1 plus r. But 1 plus r, 1 plus of r, it will be, I should write 1 plus r, it will be 1 plus 1 divided by 9, and it will be 10 divided by 9.
Okay.
Okay, so so we divided by this and minus 5. 5 we don't divide it by this accounted factor because 5 it is the value of the initial point. Yes, understanding.
Can you repeat it?
Two discounted profits, and we should find Q1 and Q2, no Q1 and Q2, but Q1 and Q2, Q2, so that the mathematical expectation will be 0.
And what is Q1 and Q2?
Yes, yes, it is a risk neutral probability. So it is this probability which give us that the mathematical expectation of this will be 0. Provide it is risk neutral probabilities are probabilities which provide that the mathematical expectation of discounted profit is 0, because its assumption it is an efficient market hypothesis. Mathematical expectation of discounted profit is 0. So we write this, and we remember that Q1 plus Q2 are probabilities, so it's their sum is equals 1, and so we find that Q1 equals Q2 and Q equals how? Understand this?
Yeah.
Yes. So it's very important how we can find these neutral probabilities. But after that, we can find we can find that fair price. But notation. We can rewrite this as no, in general site, and mathematical expectation of this difference is difference of mathematical expectation, and mathematical expectation of this, it is not a random value. So mathematical expectation of S0 equals S0, and this difference equals 0. So we can remove S sub-0 in the right side, and we get that mathematical expectation, discounted mathematical expectation of value at the end of period equals value at the beginning of period. It is as rule. So you can choose. You can use this rule for defining Q1 and Q2, but you can use this rule, that mathematical expectation discounted value of the end of period equals the value of the beginning of period. So what does it mean? It's interesting meaning. It means that doesn't matter if we buy a stock and have cumulative profit from stock. If we only deposit this value, the profit is the same. Understand this? If or you would like that I explain again?
Yes, actually, I really will.
Actually, it's clear, and it's the base of efficient market hypothesis.
Yes, but may you explain it once again?
Mm-hmm. And the next problem, what is the?
Sorry. Can you explain it once again, please?
Yes.
Please. Thank you.
In other words, efficient market hypothesis states that doesn't matter if we put our money as zero at the bank account, deposit, or we buy stocks. The profit will be the same. The mathematical expectation as sub 1 discounted equals as 0, or we should multiply this but as 0, and in left maybe I can write this. Mathematical expectation as 1 respect to Q, risk neutral probability, equals S0 multiplied 1 plus R. So you see that at the right side we deposit as 0, yes, for example, for 1 year. But in this, on the left side, you see the mathematical expectation, the value as 1 if we buy stock.
I just don't understand. We have that mathematical expectation. Why do we write Q, sub Q after the letter E? Why do we write sub Q?
Because only we can fit such value Q1 and Q2 that this equality will true. Because if we use P1, for example, and P2, the another probability, it will be true. And we would like to look through to find such probability that it will be true.
Okay.
Only this Q1 and Q2 provide this expression, this quality. And after that, we can find the fair price. And fair price, it's only mathematical expectation of the for your function. For your function was 7 and 2, and this probability we found. And after that, we should to discount this value, and it will be 4.05. After that, you can ask me, but is there are always we can find this Q1 and Q2, and I would like to answer these questions. In this graph, you see that as it is initial value of stock, and S multiplied U and S multiplied D, it is two value at the up scenario and the down scenario and the end of period. Yes, it's understand. So we write our assumption, efficient market assumption. It is that mathematical expectation, the value of stocks at the end of period is discounted equals as at the beginning, initially. And we write this as U multiplied Q1, but now we don't know what is Q1. This value multiplied Q2, we don't know it too, and divided by 1 plus R, because we would like to discount this, and it's equals S. And the second question, it is that the sum of probabilities equals 1. After that, we should divide the both side by S, you see, and multiply it by 1 plus R. This multiplied by, and the system will be, U multiplied Q1 plus D multiplied Q2 equals 1 plus R. We could
Sorry,
we could what's the question?
the question is, so U and D, those are numbers or
Numbers, yes, numbers.
they are coefficients?
Yes, numbers, coefficients. But Q1 and Q2 unknown values.
Are known or unknown?
Unknown.
Unknown.
And to this system. So you see that it is the value at the end of period multiplied by S, and it's 1 plus R multiplied by S. So we have this system. Is it clear? Yes? From this?
Yes.
Yes. So we should analyze this system, and you repeated how we can analyze the system of linear equations. We should what's condition that this system has a unique solution? Do you know?
The determinant is non-zero.
Determinant isn't zero. Yes, you're right. But if the determinant will be zero, it doesn't mean that they haven't solution, because there are another additional condition, delta 1 and delta 2. If we have the delta equals 0 and delta 1 equals 0, it means what does it mean? If both delta 0 and delta 1 0, what does it mean? Who knows? Who would like to answer?
Maybe there are infinitely many solutions to the system.
Yes, yes, you're right. But we need that delta 1, that delta differs from 0. And we find this, it is coefficient u and 1, and the next column d and 1, yes? And this determinant equals u minus d, and we write that it will be more than 0. And maybe I should write that u more than d, because it's up scenario and it is down scenario. Up, down, up, down. If we would like to find delta 1, we should substitute this column by the coefficient from right side.
I'm sorry, and what is delta 1?
Delta 1, it is a determinant for Kramer rules. Do you know about Kramer rules?
Yes.
Yes? So it is delta 1 for finding the Q1. And delta 2, maybe it is delta 2, yes. And after that, we should find Q1, as delta 1 divided by delta. Delta 1 divided by delta. And it will be delta 1 plus r minus d divided by u minus d. And this is probability. So probability should be more than 0. And u minus d from this more than 0. Should the numerator should be more than 0 too. And from this, no, it's not 4, it's Q2. Q2, this divided by delta, and similar. Denominator positive, the ratio positive, so numerator should be positive too. And we write that 1 plus r minus d more than 0. It is from this. Yes? So 1 plus r more than d. it's as this. And from this the same, you write that this more than 0, so 1 plus r less than u. And we obtain this necessary and достаточно, enough, necessary and enough condition.
Sufficient.
Enough condition, it is that 1 plus r will be more than d and less than u. So if we, for example, had problem and you see, for example, it's 10, 12, 9, some number, and you see that R is given 2, you should before you're solving check if this condition holds. 1 plus r more than d, less than u. And if these conditions hold, you should solve this system.
And if it is false?
But if it's not true, but if false, so we cannot find the unique risk neutral probabilities, and that means that market isn't complete. And there are another approach in this case.
Okay.
But
Sorry, can this theory can it be applied for the real market or not?
yes, but now today it is a very easy model, and you can ask me how we can find this u, this d, if we have a real market and we have a real historical data. But all about this will be at the next lecture.
Okay.
So it is clear, and we remove to the next slide. Next slide, it's pricing. It's about another approach, pricing by the absence of arbitrage. It's very interesting, a very interesting approach, because we don't apply probability assignments, probabilities in general, and only and only the rule of absence of arbitrage. So if we have the initial moment, assume that we buy X shares and Y derivatives. The initial price of shares of stocks is $5, and it is as in this example, initial price for stocks, for shares, $5.
Yeah. That is $5 per share.
It $5. Initial, yes, but in this example, it is doesn't matter, shares or stocks.
I mean $5 per one share.
Yes.
Okay.
And Y derivatives and their price premium. we don't know exactly, and we would like to find out their fair price. So we denote this C, no, C. So at initial moment, we paid 5 multiplied x plus c multiplied y. Is it clear?
Yes.
It's done. At initial, at the moment t equals 1, at the end of period, there are two scenarios at the end of period. If these shares will be 20 divided by 3 for 1, so and we have x shares, so we get this sum. And for derivatives, we get this sum because mhm, why this sum? Do you understand? Because it's not stock call option or put option, but it is some derivatives with this by your function 7 and 2. So in up scenario we get 7, but in down scenario we get 2, and we should repay it for finding net profit. We should repay this sum with percent. With percent. Is it clear? So now we only have the value at up scenario and down scenario, and after that we use rules absence of arbitrage. The rules absence of arbitrage, it is that the profit doesn't depend on scenario. So this value should be equals this value, and we write this value the same. So we write this equals this. But we have equation with two unknowns value, x and y. We can't solve it, but we can express y from x. Yes? Is it clear? Yes. And after that, we would like to substitute this value in the total net profit. But this profit equals this profit. So it doesn't matter we substitute in this or in this. For example, I take this and I take this, and after that I substitute y as minus 4 divided by 9x in this. And it will be the expression only from x, from x, from x, from x. And after that, I would like that this expression will be 0, because only if it is 0, we haven't profit, not who buy and not who sell this derivative. And exactly this means absence of arbitrage. And from this equation, we could find C. It is product equals 0, so this equals 0. And from this equation, we can find that C equals 4.05. And you remember that this answer coincides from answer in previous approach. Yes? So, again, the absence of arbitrage means that net profit doesn't depend on scenario. So this equals to this. And the second condition of absence of arbitrage that not seller or not buyer haven't speculative profit. So from these two conditions, we have the price of these derivatives. And it looks as a miracle of pricing by the absence of arbitrage, because we don't have assigned probabilities to compute this price. Do you understand? Is it clear? And a summary. Today we learned two approaches. The first approach is probability approach. It is risk neutral probability. And this approach is based on the efficient market hypothesis that states that discounted mathematical expectation of your function discounted mathematical expectation of discounted profit is zero. And from this approach, we can find risk neutral probability, and after that we can find the fair price of derivatives as a mathematical expectation of discounted mathematical expectation of your function with respect to risk neutral probabilities. And in our example, the your function was given, but if but for call or put option, you know that for your function, it's for call option, it is the difference between market price at the end of period and strike price with plus, so the maximum between this and zero. And in the case of put option, it is the opposite situation. You know this by your function from the first lecture.
Yes.
Yes. And now it is the old material, but we can choose. If you want, we can find the fair price from another example. For example, for this, and the second possibility for you, you can begin the test of this lecture. Maybe you should to open this test, and maybe you have questions for me. And if you want, you can use your blackboard as Sophia used at the previous lecture and find the fair price. I don't know if you have time. What do you want? Так, София. Мгм. So let us now we open the test about this lecture and to begin to perform this problem set. You agree?
Sorry, problem set or test 3? I'm confused.
Yes.
So
Test 3.
I think
or test 3.
if you want, I can show this. Mhm. You see, yes. Lecture 3 test. Suppose you have one period binomial model. The stock price at the initial momentum 20, go up 22 or go down to can go out to 17th interest rate, and write the system for finding this risk neutral probability, and after that write the payoff function if the strike price 21, and what is fair price of the derivative, what is premium, fair premium. So good luck, yes. And if you haven't questions, so we meet at the next lesson, or 11:40.
Yes, okay.
Okay. Till next time.